Welcome to Navkar Digital Institute. My name is Chartered Accountant Maulin Kadikar. I welcome all of you to Navkar. Dear students, we are going to have a discussion about CA Intermediate Examination paper of December 2021 for Financial Management. That is paper number 8A that we are going to discuss. So let us start with the discussion of the examination paper. I always suggest students to read the question paper from the beginning. Total number of questions 11, time allowed is 3 hours, number of pages 11, maximum mark 100. Answer to the questions are to be given only in English except in case of the candidates who have opted for Hindi medium. If a candidate has not opted for Hindi medium, his or her answer in Hindi will not be valued. Section A, which we are going to discuss, in that as usual question number 1 is compulsory question. Candidates are also required to answer any 4 questions from the remaining 5 questions. So from the remaining 5 we have to answer any 4 questions. That is the paper style that we have every time. Working notes should form part of respective answer. All calculations should be done up to 3 decimal places. And this is what I think is important. That's you have to keep a note that the institute is clearly providing that all your answers should be up to 3 decimal points. So whenever any of the calculation that you have in which you can go up to 4 decimals or more, then in that case don't do that. You have to restrict your answer up to 3 decimal points. First of all, I would like to solve the entire examination paper and then I'll give you the summary for all the questions, the chapters from which they have been asked, and the kind of toughness that a student would have considering a normal preparation that a student would have completed. Question number 1A. A factoring firm has offered a company to buy its accounts receivable. The relevant information is given below. The current average collection period of the company's debt is 80 days and 0.5%, that is 1/2% debtors default. The factor has agreed to pay over money due to the company after 60 days. So the collection period will reduce from 80 days to 60 days. And it will suffer all losses of the bad debts also. Means it is non-recourse factoring services. The responsibility of the bad debts is of the factor and not of the company. Factor will charge commission at the rate of 2% for collecting the receivable. The company spends rupees 1 lakh per annum on administration of the debtors. Very good clarification is made that these are avoidable costs. Even if such clarity is not given, we can make that assumption every time. Annual credit sales are rupees 90 lakhs. Total variable cost is 80% of the sales. The cost of borrowing is 15% per annum. Assume that there are 365 days in a year. Should the company enter into agreement with the factoring firm? That is the question. So from this information we are required to decide whether to appoint the factor or not. So friends, over here we have been provided with the 2 options. Option number 1 is continuing with in-house management of receivable. That is the first option that we have. And option number 2 is that we appoint the factor. That is the way the 2 options are there. The question is providing the information. First information, current average collection period for the company's debt is 80 days. So average collection period is provided as 80 days. 1/2, that is 0.5% debtors default. So percentage of the bad debts is 0.5%. the factor has agreed to pay money overdue to the company after 60 days. So the first advantage that we can see is reduction in the collection period, and will suffer any loss on account of bad debts. It means that the loss on account of bad debts will reduce to 0. Factor will charge commission at the rate of 2%. It means that the factoring commission is given. It is at the rate of 2%. The company spends 1 lakh rupee per annum on administration of the factor, means a kind of collection cost. It is an amount of rupees 1 lakh. Later on it will be 0. Annual credit sales are rupees 90 lakhs. Annual credit sales is given 90 lakhs. Variable cost is 80% of the revenue. And we have been provided with the cost of capital as 15%. So cost of capital is given to us as 15%. And we have been given that the 1 year is equal to 365 days. Dear students, from this information we are required to decide whether to appoint the factor or not. In absence of an information, we assume that the sales is going to remain same, that is an amount of 90 lakhs. Variable cost is always going to remain same in the proportion to the revenue, that is 80%. Since over here we can say that we are required to take a simple decision regarding whether to appoint the factor or not, we can compute that what is the profit or loss right now, what is the profit or loss once you appoint the factor, and based on that you can take decision. That is the way simply we can take the decision. So the answer would be like this. Step number 1, usually I do working like this. I suggest students calculation of total fixed cost. In this question the total fixed cost information is not given, so we are just ignoring it. Step number 2, calculation of variable cost to sales ratio. That is again provided to us in the example directly. It is 80%. So step number 3, calculation of the profit or loss for in-house management of receivable and with appointment of factor. And of course the option which is having higher profit will be selected. So it is in-house management of receivable and the other one is factoring services. We have to compare both of them for decision making. So we start with the sales value. Sales value is given right now as 90 lakhs. Variable cost is 80% of the revenue. So use your calculator. 90 lakhs into 0.8. That comes to 72 lakhs. Then we will deduct, that is we'll compute the carrying cost. As far as the carrying cost is concerned, it is 72 lakhs divided by 365 days, which they have clearly specified to take. That's really good. Multiplying with the collection period is right now 80 days into cost of capital 15%. So 72 lakhs into 8080 into 0.15 divided by 365. So that comes to 2,36,712.32. That is the carrying cost. Next is the bad debts. It has been given that say the 0.5% of the customer's default. So 90 lakhs into 0.5%. That comes to 45,000. Next is the collection cost. It is an amount of rupees 1 lakh. These are the expenses that we have, which we will deduct from the revenue to compute the profit or loss. As far as the factoring commission is concerned, right now there is no factoring commission. It will come in case of the factoring option. Dear students, we have made an assumption that the sales value will remain same, that is 90 lakhs. Variable cost will be 72 lakhs. Carrying cost will be calculated instead of taking 80 days, say taking 60 days. So it is 72 lakhs divided by 365 multiplying with 6060 into 0.15. This is the way the carrying cost will be found. So 72 lakhs into 6060 into 0.15 divided by 365. So it comes to 1,77,534.25. This is the carrying cost. Bad debts will not be incurred. There is clarification that say they have that is made in the question. It is non-recourse. Collection cost will not be incurred. Factoring commission is provided to us. The factor will charge commission at the rate of 2%. So it is 90 lakhs into 2%. That is the way we will compute the factoring commission. $1,80,000. All these expenses will be deducted from the revenue to compute the profit or loss. Let us see that say how to make the calculation of answer. I request you to use calculator along with me. 90 lakhs minus 72 lakhs minus 236,712.32 minus 45,000 minus 1 lakh rupee. It comes to 14,18,287.68. This is the way the existing profit can be calculated. In case of the proposed 90 lakhs minus again 72 lakhs minus 1,77,534.25 minus 1,80,000. So again there is a profit of 14,42,465.75. That is the way we have the profit. Okay. We can see that say in case of the proposed, the profit is more than the present. So the company would advise that say you should appoint the factor. This is a very simple method by which you can do answer. If at all somebody wants to do with the incremental approach, even in that case he or she can do with the incremental approach. In that case, just I am explaining to you that say how will you have the answer to be calculated. We can say that say there will be advantage of savings in carrying cost. Why? Because that is collection period reduces. That is savings of bad debts. Next will be savings of collection cost. So these are the three advantages that say you will have, which you can compute like this. That is 90 lakhs into 0.8, that is 72 lakhs divided by 365 into 80 minus 60. So it reduces by 20 days into 0.15. So use your calculator. 90 lakhs into 0.8, 72 lakhs into 20 into 0.15 divided by 365. So it comes to 59,178.08. This is the savings in carrying cost. 90 lakhs into 0.5 percentage. The savings of the bad debts is 45,000. Savings of collection cost 1 lakh. So basically these three are the advantages. Against that, you will be having payment of the factoring commission. Which has been provided as 2%. So in that case, it is 90 lakhs into 2%, 1,80,000. So I request all of you to use your calculator. 59,178.08 plus 45,000 plus 1 lakh minus 1,80,000. So there is an advantage of appointment of the factor by 24,178.08. And friends, if at all you will compute difference of this two, it will be exactly the same. Let us check the answer. 14,42,465.75 minus 14,18,287.68. So it comes to 24,178.07. So we can say that doing answer by either of the method will reach to the same conclusion, that the company should appoint the factor. So the answer is the company should appoint factor. That is the way we will take the decision. Next question, question number 1B. Book value capital structure of B Limited is as follows. There are three sources of finance provided to us: debentures, retained earning and equity shares. Currently, the market value of the debenture is 110 rupees per debenture. It has a face value of 100, but market value is 110. And equity share is 180. Face value is 100, but market value is 180. The expected rate of return to equity shareholder is 24% per annum. The company is paying tax at the rate of 3030%. Calculate WACC, weighted average cost of capital, on the basis of market value weights. That is the question. So over here the question says that you are required to make the computation of the weighted average cost of capital, and in that, importantly, you are required to take the market value weights. Dear students, over here, directly or indirectly, no information is given about the redemption of the debenture. So assuming that the debentures are issued for perpetuity, we will make the calculation of the cost of debt financing. Because for calculating the weighted average cost of capital, we require the information of cost of debt financing. So answer for question number 1B, working note number 1, calculation of cost of debt financing. It will be calculated by using a very simple formula, interest into 1 minus T divided by amount. Rate of interest is provided as 100%, that is 100 rupees. Rate of interest is 12%. Income tax rate is 30%. Divided by the amount. Friends, we understand that whenever we are taking into account the existing security to make the computation of the weighted average cost of capital, then we are making the computation of the cost of capital as if we are going to issue similar security now in the market. And at this point of time, if at all we issue the security, we can get 110 rupees. Because in the secondary market, the price is 110. So 100 into 12%, that is 12 rupees. Into 0.7, that comes to rupees 84. Divided by 110 into 100 for getting answer in percentage term. That comes to 7.64%. This is the way the KD is calculated. As far as the cost of equity is concerned, for that we have been provided with the direct information, it is 24%. So taking into account the market value of the equity share and market value of the debentures will make the computation of the weighted average or overall cost of capital. So calculation of weighted average cost of capital using market value weight. Column number 1, source of finance. Column number 2, amount. Third column will be weight or proportion in which we have raised the funds. Cost. Weight into cost. That is the way the weighted average is calculated. Dear students, we understand as far as the retained earning is concerned, it does not have its separate market value. Its value is always included in the equity share value. So we will have the equity shares 45,000 into market price 180. Debentures 6,000, its market value 110. That is the way we will compute the amount. Its weight will be calculated, its weight or proportion into cost of capital. For equity share it is 24% and for debentures we have calculated. Language of the question is very clear. We are required to compute the answer using the market value weights. So in source of finance, I am writing first of all as per the sequence of the question, debentures. In amount column I am writing 6,000 multiplying with market price is 110. That comes to 6,60,000. Okay. Then equity shares. In that once again 4,500 into market price is provided as 180. That comes to 8,10,000 plus 6,60,000, so it is 14,70,000. Based on that, I will compute the weight or proportion 6,60,000 upon 14,70,000. So it is 0.4489 or 0.4490 or 0.449. 1 minus 0.449, it comes to 0.551. Friends, over here it is 8 rupee 40 paise because 12 into 0.7. So 8 rupee 40 paise into 100 divided by 110, that is 7.636. This is 7.636. The other one is already provided to us in example 24. So use a calculator along with me. 0.449 into 7.636. It comes to 3.429. 0.551 into 24. It is 13.224. 3.429 plus 13.224, that comes to 16.653. That is the way we compute the weighted average cost of capital, or it is also given a name as overall cost of capital using the market value weights. So revising the answer, the first working note is calculation of KD. First, we have made an assumption that the debentures are issued for perpetuity. Second, we understand that always cost of capital is calculated using the present security, considering if at all we issue such security now in the market, what is the cost. So the amount received by the company, in that I have taken 110, that is the current price. Interest is to be paid on the face value, 100 into 12%, that comes to 12 rupees, into 1 minus 0.3, that is post tax, it comes to 8 rupee 40 paise, and the KD is 7.636. Weighted average cost of capital, retained earning does not have its separate market value, its market value is included in the market value of the equity shares. Computing the market value of the security, calculation of the weight, 6,60,000 upon 14,70,000, 8,10,000 upon 14,70,000, multiplying with the respective cost will give the weighted average or overall cost of capital. Next question, question number 1C. X Limited is a multinational company. Current market price per share is rupees 2185. That is P0 is given to us. During the financial year 2020-21, the company paid rupees 140 as dividend per share. The company is expected to grow at the rate of 12% per annum for next 4 years, and then at the rate of 5% per annum for perpetuity, that is what we understand, for an indefinite period. Expected rate of return of shareholders is 18%. So friends, cost of equity is given as 18%. Find out intrinsic value per share. So we are required to make the calculation of the equilibrium price per share. Let us understand and say how to make the calculation of answer. So friends, over here, let us understand how to make the calculation of answer. The question says that compute the intrinsic value per share, means we are required to compute the equilibrium price per share. That is what we understand. The question is providing the P0 information, yet the question says that compute P0. It means that the given P0 is the market price of the equity share in the secondary market, and intrinsic value or equilibrium value or fundamental value means the price of the equity share using the dividend discount model approach. Yes, we are required to make the computation of the present value of the dividend income, and that is the current market price of equity share. Understand carefully, dear students. We have to solve this question from an investor point of view. Whatever the income that investor is going to receive in future, present value of the same is P0. That is the way we are required to compute the P0. So listen carefully what I am going to speak. First year, second year, third year and fourth year. We understand that the dividend per share, it is 140 rupees plus growth rate of 12%. That is the dividend income for the first year plus 12%, second year plus 12%, third year plus 12%, fourth year. Whatever the dividend income that investor is going to receive from end of year 1 to end of year 4 will be discounted in present value term. And for that, say we will apply the discounting factor 18%. Then we will make the calculation of the P4. As far as the P4 is concerned, it is calculated as D5 divided by KE minus C. How to compute D5? D5 will be calculated as D4 into 1 plus G divided by KE minus C. That is the way we are required to make the computation of the P4. P4 can be understood by two methods. One is price of equity share which investor will be able to receive at the end of the fourth year, and at the same time it can be termed as from fifth year onwards for perpetuity. Whatever dividend income that investor is going to receive, all of them have been discounted to fourth year end, that is called P4. This is the process that we are required to adopt for calculation of P0. So the first 4 years dividend and P4, all of them would be discounted in present value term for the purpose of P0 calculation. One more clarification that I want to give you, dear students. What happens at a number of times the students are having a contention like this, that we know that the K is equal to D1 upon P0 plus G. This is the formula that we already have studied. G is transferred on the opposite side, so K minus C is equal to D1 upon P0. P0 is transferred on the left hand side, so it is P0 is equal to D1 upon K minus C. This is the way we make the calculation of the P0. However, this formula is not applicable in this example. Why it is not applicable? Dear students, as far as the application of this formula is concerned, it has a condition that says this growth rate should be constant for perpetuity, so from the very first day. However, we can see that say for the first 4 years, the growth rate is different in comparison to the perpetual growth rate. That is the reason, say we cannot apply this formula for the purpose of making calculation of P0. Application of this formula is not acceptable. Instead of that, say we are required to adopt a procedure like this for calculation of the P0. So the sequence in which I suggest students to do answer is this. First working note will be calculation of the dividend per share for 5 years from end of year 1 to end of year 5. Second working note will be calculation of the P4, that is price of security at the end of the fourth year, which has two meaning: the sale value of the security at the end of the fourth year and discounted value of the dividend at the end of the fourth year to be received by the investor from fifth year onwards for perpetuity. And lastly, all of them will be discounted in present value term to compute P0. For the purpose of doing first part of the question, the information about the current market price of the equity share which is given to us is of no use. So let us start calculating the answer. Working note number 1, calculation of dividend per share year 1 to year 5. That is the way we'll compute the dividend per share. Column number 1 is year, column number 2 is dividend per share. First year, second year, third year, fourth year and fifth year. This is the dividend from end of year 1 to end of year 5. So it is 140 rupees and it will grow at the rate of 12%. So we understand that say for end of year 1 it is 140 into 1.12 that comes to 156.8. For the next year it is 175.616. Dear students, as far as the second year dividend is concerned, that you could have calculated as 156.8 into 1.12 raised to 1. This is also the way you can calculate the answer. Next year it is 196.6899, so I am taking 69. Similarly, say the third year dividend can be calculated as 175.616 into 1.12 raised to 1. That is, the preceding year's dividend can be increased at the rate of 12%. 196.69 into 1.12, so 220.293. Now, importantly friends, be little bit careful that after 4 years, the growth rate is 5%. So, it is 220.293 into 1.05 raised to 1. That comes to 231.308. This is the way the dividend per share can be calculated from end of year 1 to end of year 5. Next, working note number 2. Calculation of P4. P4 means price of equity share at the end of the 4th year. It is D5 divided by K minus C. 5th year dividend is 231.308 divided by cost of equity is 18%. Growth rate is 0.05. So 231.308 divided by 13%. So 1779.292. This is what we understand is of year 4 end. That is market price of the equity share at the end of the 4th year. Now lastly, calculation of P0. It is also given a name as intrinsic value. It is also given a name as fundamental value. It is also given a name as the price of equity share using the dividend discount model approach. So column number 1 is year. Column number 2 is cash flow. The third column is the discounting rate. That is 18%. And the last column is the present value. That is the way we will compute the P0. First year, second year, third year and 4th year. An investor will receive this amount of the dividend from end of year 1 to end of year 4 and 4th year end this price. All of them would be discounted with the discounting factor which is given to us in the question. Here is the discounting rate. And based on that, we will compute the price. So friends, we will be having year 1 cash inflow in form of dividend income. Second year it is again dividend income. Third year it is again dividend income. Last year, apart from the dividend income, P4 value. So it is 220.293 plus 1779.292. So the total of both of them is 1,999.585. Now discounting, that's very simple. First year factor is 0.847, second year it is 718, third year it is 608, fourth year it is 0.515. So we'll discount the cash flows, say using these factors. 156.8 into 0.847, that comes to 132.8096. so I'm taking 810. 175.616 into 0.718, that is 126.092. 196.69 into 0.608, that is 119.588. Next is 1,999.585 into 0.515, that comes to 1029.786. Total of all of them is P0. So it is 132.81 plus 126.092 plus 119.588 plus 1029.786. So it is 1408.276. Importantly, friends, remember that taking into account the fifth year income, that is fifth year dividend income, whatever the value that say we compute, it is of the fourth year end. That is what say you have to understand it carefully. Okay, the price that we have calculated is 1408.278. The question says further that say you are required to answer whether the security is overpriced or underpriced. That is a question. So we understand that say the actual price of the security is given to us in the question is 2185. Actual price of the security is more, so we understand that say the security is overpriced, and we understand that say if at all we are required to advise the investor, we would advise him not to buy the security, and if at all you are currently holding it, you should sell security. That is what we understand. Remember that say we have to understand that whatever the price that say we have calculated is correct price. The price which is prevailing in the market is wrong price. If it is more, then it is overpriced. If it is less, then it is underpriced. So write an answer further. Actual price of security is rupees 2185, comma, it is more than equilibrium price, so it is overpriced. That is what we understand. We don't have to write any decision. Otherwise, how to write decision is also what we have discussed. Friends, over here it is 276. Okay. So this is the way we draw the conclusion. Let us see the next question. Question number 1D. A garment trader is preparing cash forecast for first 3 months of the calendar year 2021. So we have been provided with the forecasting of the cash for first 3 months of year 2021. His estimated sales for the forecasted period are as follows. For January 6 lakhs, February 6 lakhs and March 8 lakhs. The figures are in 1000 term. Total sales information is given. The trader sells directly to public against cash payment and to other entities on credit. Credit sales are expected to be 4 times the value of the direct sales to the public. He expects 15% customers to pay in the month in which the credit sales are made, 25% to pay in the next month, and 58% to pay in the next to next month. The outstanding balance is expected to be written off. The purchases of the goods are made in the month prior to the sales and it amounts to 90% of the sales and are made on credit. Payments for this occur in the month after the purchase. Very good clarification is made. No inventories of the goods are held. On 1st of January 2021, cash balance is 50,000. Actual sales for the last 2 months of the calendar year 2020 are as follows. For November month and for December month, 6,40,000 and 8,80,000. You are required to prepare the monthly cash budget for the 3 months starting from January to March. So we are required to prepare the cash budget only for 3 months, say starting from January to March. Let us have understanding that say how to make the calculation of answer. Friends, over here, first of all, we will be preparing a working note for calculation of the purchase and payment for purchases. That is the first working note that say we will prepare. In case of the cash budget, what happens at say many a times you cannot know at the beginning of the calculation that which information may be useful to us. So we'll prepare this working note exhaustively starting from the month of November to the month of March. So working note number 1, calculation of payment for purchases. In that, we will work out the answer like this. Column number 1 will be month. Column number 2 will be sales. Then it has been given to us purchase of the goods are made in the month prior to the sales and it amounts to 90% of the sales and are made on credit. So I am making the calculation of 90% of sales. Based on that, I will compute the purchase. And lastly, the payment for purchases. This is the way we are required to say prepare the working. We will prepare this say from the month of November. So we are starting with the information. In the month of November, the sales is 6,40,000. In the month of December, sales is 8,80,000. In the month of January, sales is 6 lakhs. In the month of February, sales is again 6 lakhs. In the month of March, it is an amount of 8 lakhs. Then I am calculating 90% of the sales. So it is 5,76,000. So 6,40,000 into 90%. Then 8,80,000 into 90%, 7,92,000. 6 lakhs into 90%, 5,40,000. Again 5,40,000. 8 lakhs into 90%, 7,20,000. This is the way we make the computation of the 90% of the sales. Language of the question is very clear, dear students. purchases of the goods are made in the month prior to the sales, that is 1 month before, and amounts to 90% of the sales and are made on credit. So the next column is purchase. In the month of November, the purchase would be an amount of 7,92,000. In the month of December, purchase would be 5,40,000. In the month of January, again the purchase would be 5,40,000. In the month of February, purchase is 7,20,000. The question does not provide the information what is the purchase of March. Definitely friends, it would not be required. That is the reason it has not been given to us. Okay. Payment for this occurs in the month after the purchase. It means that we have, in a simple language, average payment period of 1 month. Whatever we have purchased in the month of November, that we would have paid in the month of December. So we are ignoring it. Whatever the purchases of December must have been paid in the month of January, that is an amount of 5,40,000. Purchase of January will be paid in the month of February, that is an amount of 5,40,000 once again. Purchase of February will be paid in the month of March, that is an amount of 7,20,000. This is the way we are required to make the computation, that what is the payment for the purchases in the month of January, February and March. Now next I am preparing a working note, calculation of the amount of the cash sales and credit sales. Because we have been provided that the total sales is split into two parts. One is the cash and another is credit. So working note number 2. Calculation of cash sales and credit sales. Dear students, it has been provided to us like this over here in the first paragraph, that the trader sells directly to public against the cash payment. It means it is cash sales, and to other entities on the credit. Credit sales are expected to be 4 times the value of the direct sales to the public. So friends, over here we understand cash sales, credit sales and total. It has been given that the credit sales are expected to be 4 times of the value of the direct sales to the public. So if this is X, then this is 4X and total of both of them is 5X. So use a calculator. 4 upon 5, that comes to 80%. In short, 80% of the sales is on credit and 20% is on cash. That is the way the information is given to us. So whatever the sales value which we have been given to us in the question will be split into 2 parts, cash and credit. So we will be having the working of the answer like this. Column number 1 is month. Column number 2 is sales. Third column is cash sales. And the last column is credit sales. When do we recover the credit sales? I am not focusing on that for the timing. Column number 1, column number 2, column number 3 is equal to second column into 20%. Column number 4 is equal to second column minus third column. This is the way we compute the credit sales. We start again from the month of November, because which information may be useful we do not know. So it is November, December, January, February and March. The sales value which is given to us in the question is 6,40,000. Then it is 8,80,000. Then it is 6 lakhs, 6 lakhs and 8 lakhs. 6 lakhs, 6 lakhs and 8 lakhs. That is the way we will be having, say, the sales on monthly basis. So it is 6,40,000 into 0.2, that comes to 1,28,000. And the remaining 5,12,000 is the credit sales. How to make the collection of the credit sales? I'll come to that point after some time. 8,80,000 into 20% once again, 1,76,000. The remaining is the credit sales, 7,04,000. 6 lakhs into 20%, that comes to 1,20,000. The remaining is the credit sales, 4,80,000. Again 6 lakhs into 20%, 120. Remaining is the credit sales, 4,80,000. 8 lakhs into 20%, 1,60,000. The remaining is the credit sales, 6,40,000. This is the way we will have the bifurcation of the total sales into cash sales and credit sales. Now I think that we can start preparing the cash budget. So cash budget on monthly basis from January 21 to March 21. Column number 1 will be particulars. Column number 2 will be January month, February month and March month. This is the way we are required to prepare the cash budget. So friends, over here the opening cash balance is given as 50,000. So we start with the opening balance, an amount of rupees 50,000. Then very simple cash sales. On monthly basis, the amount of the cash sales we already have calculated. Of course, we will focus for January to March. That is 120, 120 and 160. 1,20,000, 1,20,000 and 1,60,000. So whatever the sales that we have of January 600, February 600 and March 800, 20% of that. The next is the collection of credit sales. As per the given information, dear students, the collection of the credit sales is made in 3 installments. It has been given to us like this. 15% customers are expected to pay in the month in which credit sales are made. 25% to pay in the next month and 58% will pay in the next to next month. In short, friends, we are going to have the collection in 3 installments. That is 15%, 25% and 58%. We understand that say 15 plus 25 plus 58, total is 98. It means 2% is the bad debts. The amount that we do not receive, we don't have to discuss that. Why? Because we are preparing the cash budget. As far as the sales, credit sales of the January is concerned, it is 4,80,000. So what will happen, dear students? 15% of 4,80,000 will be collected in the month of January only. So in the column of the January and against 15%, I am writing the collection in the month of January. Then it is 4,80,000 into 25%. We understand that it will be collected in the month of February. So against 25% and in the month of February, we will mention 25%. Last, 4,80,000 into 58%. That will be collected say in the month of March. This is the way we will be having the collection of the credit sales of the January will be collected in January, February and March. Okay, what is the credit sales of February? It is coincidentally same, 4,80,000. So we will mention over here 4,80,000 into 15%. That will be collected in the month of February only. So against 15% and in the month of February we are mentioning. Next is 4,80,000 into 25%. That will be collected in March and the remaining will be collected in April. But we are not concerned that what is the collection after March. As far as the credit sales of the March is concerned, it is 6,40,000. So 15% of 6,40,000 will be collected in the same month. The remaining will be collected in April and May, but we are not concerned with that. Before January, it is the month of December. Credit sales of the December month is 7,04,000. We understand that 15% of that must have been received in the month of December. 25% will be received in the month of January. So 25% of 7,04,000, this. And 58% will be received in the month of February. We have been provided with the sales of the November month also. Credit sales of the November, of that 15% must have been received in the month of November, 25% in December. Whatever the collection that you already have made, its effect must have been incorporated in the month of opening of the January balance. Remaining will be collected in the month of January. So we understand it is 5,12,000 into 58%. This is the way we will have the collection in the month of January, February and March. So let us calculate the answer now. 4,80,000 into 15%, that comes to 72,000. 4,80,000 into 25%, 1,20,000. 4,80,000 into 58%. That comes to 278,400. This is the way the collection of the January month credit sales. Again 480 into 15%, that comes to 72,000. 480 into 25%, 1,20,000. 6,40,000 into 15%, that comes to 96,000. Credit sales of the December, 7,04,000. Of that 25% will be received in January, 1,76,000. 7,04,000 into 58%, that will be received in the month of February, 408,320. 5,12,000 into 58%, 2,96,960. This is the way we will have the collection. Now friends, we already have calculated what is the payment for purchase of like the goods. For January it is 540, for February it is again 540, and for March it is 720. So payment for purchases. $5,40,000 in January, 5,40,000 in February, and 7,20,000 in the month of March. This is the way we'll compute the closing balance at the end of every month. So now the closing balance will be found like this. Opening 50,000 plus 1,20,000. plus 72,000 plus 1,76,000 plus 2,96,960 minus 5,40,000. So the closing balance is 174,960. Closing of January will become opening of February. 1,74,960 plus 1,20,000 plus 72,000 plus 1,20,000 plus 4,08,320 minus 5,40,000. It is 3,55,280. Closing of February is opening of March. 3,55,280 plus 1,60,000 plus 96,000 plus 1,20,000 plus 278,400 minus 7,20,000. So 2,89,680. This is the way the closing balance can be calculated from January to March. So let us have a small summary of the entire answer. In the first working note, we have calculated that what is the payment for purchases. Based on the revenue, we have made the computation that say what is 90% of the sales. Accordingly, the purchases are calculated and payment for purchases are calculated on monthly basis. Then the proportion, that is split, is given between the cash and the credit sales. Credit sales is 4 times of the cash sales, so the total sales is 5x. So we have made a split that say what is the credit and cash sales. Again, for like these 5 months, calculation is made. Then the cash budget, in which the opening balance is given to us. Of course, cash sales we have to write as it is. Collection of the credit sales will be in 3 installments, and there is certain percentage of the bad debts. What is percentage of bad debts? That we need not to calculate. Payment for purchases, and that is the way the closing balances are calculated. Next question, question number 2, that is of 10 marks. As far as these questions that say we have solved, all these questions of 5 marks, but now we are going to start with the question with the 10 marks weightage. That is the usual paper, that is the paper pattern that they have. There is nothing surprising. Following are the data in respect of ABC Industries for the year ended 31st of March 2021. Debt to total assets ratio is 0.40. Long-term debt to equity ratio is 0.30, that is 30%. GP on the sales is 20%. GP on sales is not required to be mentioned. GP is always as a percentage of the sales. Accounts receivable period, that is average collection period. Quick ratio 0.9. Inventory holding period is 55 days. COGS is 64 lakhs. Equity share capital is given 20 lakhs. Reserves and surplus is required to be found. Long-term debt is also required to be found. Creditors is required to be found. The total is provided 50 lakhs. Fixed asset we are required to find. Stock, debtors, cash is required to be calculated. Complete balance sheet of ABC Industries as on 31st of March 2021. All calculations in the nearest rupees. So we do not have to write up to 3 decimals over here. And assume there are 360 days in a year. So the question is providing that say whenever you are required to use the number of days, you have to take 360. It is a question from the chapter of ratio analysis. So let us have understanding how to make the calculation of answer. Dear students, we have been provided with the debt to asset ratio is 0.40 and long-term debt to equity is 30%. So logically, friends, we understand that this debt means the total debt. Total liability itself is the total assets, that is 50 lakhs. 40% of 50 lakhs comes to 20 lakhs. So the total of this two would be 20 lakhs. That is the way we can make the calculation of the total debt. And so on we'll make for the calculation. So let us start doing answer. So answer for question number 2A. In that, calculation of total debt. In bracket I am writing long-term debt plus accounts payable, I think. Creditors, that is accounts payable. So it will be calculated as debt to total assets ratio is provided 0.40. So it is debt upon total assets. Is equal to 0.40. So debt will be total assets into 0.5. 50 lakhs into 0.4. That comes to rupees 20 lakhs. So we have made this calculation. It is an amount of 20 lakhs. So reserves and surplus can be calculated as balancing figure. So working note number 2. Calculation of the reserves and surplus. Total of the liability side is equal to equity share capital plus reserves and surplus plus total debt. So reserves and surplus is equal to total of the liability side is 50 lakhs minus equity share capital is given to us in the question, it is 20 lakhs minus the total debt that we have found is again 20 lakhs. So this is an amount of 10 lakhs. So we have made this calculation 10 lakhs. The question is providing long-term debt to equity ratio is 30%. So we have been provided this information. As far as the equity is concerned, friends, equity share capital plus reserves and surplus is the total equity. So we understand it is 20 lakhs plus 10 lakhs, that comes to 30 lakhs into 0.3, that comes to 9 lakhs. So this will be 9 lakhs and this will be balancing figure, that is an amount of 11 lakhs. So working note number 3. Calculation of long-term debt. Long-term debt will be calculated using the information long-term debt to equity ratio is 30%. So it is long-term debt divided by equity. Dear students, the term equity stands for equity share capital plus reserves and surplus. It is 0.30. So long-term debt is equal to 20 lakhs plus 10 lakhs, that is an amount of 30 lakhs into 0.3. Because reserves and surplus is 10 lakhs and the question is already providing the equity share capital 20 lakhs. So long term debt would be 20 lakhs plus 10 lakhs, 30 lakhs into 0.3, that is 9 lakhs. Now we can compute the current liabilities, that is accounts payable as balancing figure. Next is calculation of accounts payable. That will be found as total debt, that is to outsiders, is equal to long term debt plus accounts payable. So accounts payable is equal to total debt, that is an amount of 20 lakhs minus long term debt. So 20 lakhs minus long term debt is 9 lakhs. This comes to 11 lakhs. This is the way accounts payable can be calculated. Okay. Next information. This two are done. GP is provided as a percentage of the sales, 20%. However, we do not have the information about the sales, so we cannot make the calculation of GP. Average collection period information, yet we cannot use it. Quick ratio, yet we cannot use it. As far as the inventory holding period is concerned, it is 55 days and COGS is given. So dear students, taking into account the COGS and GP ratio, we can compute the sales. Once you compute the sales, you can compute the debtors. So let us make the subsequent working. Working note for calculating sales. We understand that the sales, gross profit and COGS. GP ratio is provided as 20%, means for every 100 rupees of the sales, gross profit is 20 and COGS is 80. The question is providing the COGS as 64 lakhs. So sales would be calculated as balancing figure. So sales would be found as 64 lakhs into 100 divided by 80. That comes to 80 lakhs. This is the way the sales will be calculated. Next is calculation of debtors. Because the next information, average collection period, is given to us. Dear students, average collection period is found as, there are 360 days to be taken. So 360 days divided by annual credit sales. And in absence of an information, we'll assume the entire sales is on credit into average debtors. However, the average information is not available, so we are required to take only debtors. So debtors would be annual credit sales divided by 360 days into average collection period. So it is 80 lakhs divided by 360 into collection period is 36 days. So in that case, it is 1/10 only directly. 80 lakhs into 36 divided by 360, it is of course 8 lakhs of rupees. Okay. So we have used the information of the GP ratio. We have used the information about the debtors. The next information is provided to us as quick ratio. And we can see that the inventory holding period is also provided to us. So using the COGS and inventory holding period, we can compute the stock. Okay. So next is the calculation of stock. It will be calculated as inventory holding period is equal to 360 days divided by COGS, cost of goods sold, into, again, instead of average inventory we are required to take only inventory because sufficient information is not given. That is the reason. Stock is equal to COGS upon 360 days into inventory holding period. COGS is provided to us an example, an amount of 64 lakhs divided by 360 days into inventory holding period 55 days. That comes to 9,77,778. This is the way the stock is calculated. Now friends, we have been provided with the information about the quick ratio. We have quick ratio, yes. We have current liability, yes. We have stock, yes. So we can compute the current assets. The current assets is consisting of three components. As per the given information over here, inventory, accounts receivable. So the cash balance will be found as balancing figure. So current assets and based on that cash. So next is the calculation of current assets using quick ratio information. It is current assets minus stock divided by current liabilities. So it is 0.90 is equal to current asset value is required to be found. Stock we already have found. Dear students, I do not make the calculation up to 3 decimal because language of the question clearly says all calculations should be in nearest rupees. So you don't have to give answer in fraction. Divided by current liabilities, that is the accounts payable which we have found. It is an amount of 11 lakhs. So 0.90 into 11 lakhs is equal to current assets minus 9,77,778. So current assets is equal to 11 lakhs into 0.9, that comes to 9,90,000 plus 9,77,778. So it comes to 19,67,778. That is the way the current assets is calculated. Okay. Now calculation of the cash in bank. Current assets is equal to inventory, that is stock, plus debtors accounts receivable plus cash and bank. So the cash will be calculated as current assets minus inventory minus debtors. Current assets is 19,67,778 minus stock is 9,77,778 minus the debtors is an amount of rupees 8 lakhs. So it is 1,90,000. This is the way the cash and bank balance is calculated. The fixed asset will be found as balancing figure. Lastly, calculation of fixed asset. Total assets is equal to fixed asset plus current assets. So fixed asset is total assets minus current assets. Total assets will be equal to the total liabilities 50 lakhs minus current assets is 19,67,778. So it is 30,32,222. This is the way the fixed asset can be calculated. So final answer will be like this. Balance sheet of Messrs. ABC Industries as on 31st of March 2021. Liability amount, asset amount, equity share capital that is given to us in the question, an amount of rupees 20 lakhs. Reserves and surplus we have calculated. Long term debt we have calculated. Accounts payable we have calculated. On the asset side we will have fixed asset, inventory that is stock, accounts receivable, and cash. This is the way we are required to prepare the balance sheet. So here is the final balance sheet that we have. Equity share capital 20 lakhs, reserves and surplus 10 lakhs, long term debt 9 lakhs, creditors accounts payable 11 lakhs. That is the way the liability side total is 50 lakhs. On the asset side, the fixed asset 32,222, stock 9,77,778, debtors it is an amount of 8 lakhs, cash and bank it is an amount of rupees 1,90,000. Certain ratios which have been given to us, debt to total assets ratio, that you can see it is matching over here. Debt is considered to be the total debt, that is an amount of 20 lakhs divided by 50 lakhs, that comes to 40%. Long term debt to equity ratio, wherein we understand that say this is 9 lakhs, 9 divided by 30, that comes to 0.30. GP ratio 20%, that was calculated for the purpose of calculating sales. Debtors, that is average collection period 30 days, that is 36 days, quick ratio, and so on. The values have been used by us. Finally, let us have the revision of the entire answer. First of all, we make the calculation of the total debt, taking the total liability itself as the total assets. We have computed the total debt, that is an amount of rupees 20 lakhs. On the liability side, we have the total liabilities of 50 lakhs. Equity share capital is 20 lakhs. Total debt is again 20 lakhs. So the remaining is reserves and surplus 10 lakhs. Equity share capital plus reserves and surplus is total equity, that is an amount of 30 lakhs. 30% of that is the long-term debt 9 lakhs. Total debt is 20, long-term debt is 9, so the accounts payable creditors is 11 lakhs. GP ratio is 20%. So for every 100 rupees of the sales, 20 rupees is GP and COGS is 80. COGS is an amount of 64 lakhs. So the sales will be calculated an amount of 80 lakhs. Sales is there 80 lakhs, average collection period 36 days. So the debtors value will be an amount of 8 lakhs. Stock, it will be calculated using COGS and inventory holding period information, that is 9,77,778. Next is the current assets calculation. Current liabilities we already have found. Stock we have calculated. So we can compute the current assets. Current assets is consisting of 3 components: debtors, stock, and the balancing figure is cash and bank, 1,90,000. On the asset side, fixed asset is found as balancing figure, and this is the way we complete the balance sheet. Starting with the question number 3. Earning before interest and taxes, that is operating income, of a company are rupees 4,50,000. Currently the company has 80,000 shares of 10, retained earning of 12 lakhs, and it pays annual interest of 1,20,000 on 12% debentures. The company proposes to take up an expansion scheme for which it needs an additional funds of 6 lakhs of rupees. It is anticipated that after expansion, the company will be able to achieve same return on investment as at present. It can raise funds either through debt financing at 12% or by issuing equity share at face value. Income tax rate is only 40%. Compute EPS if additional funds raised by way of debt financing, if additional funds raised by way of equity shares. Advise whether the company should go ahead for the expansion and which source of the finance should be preferred. That is what they have provided to us. So over here we are required to make the calculation of the earning per share, and we are required to take a decision whether the company should go ahead for the expansion plan or not. And if at all you are suggesting the expansion plan, then which source of the finance should be selected? That is the question. So friends, over here it's very simple for us to answer something like this in this sequence. First of all, we'll make the calculation of the current capital employed. Current capital employed is consisting of 3 components. One is the equity share capital, second is the reserves and surplus, and third is the debt financing. That is the capital employed. EBIT upon capital employed into 100. That will give us return on capital employed or a return on investment. That is the second thing that we will compute. Language of the question is clearly specifying, say when you will expand your business, you will be able to earn at the same rate at which you are earning right now. That is the reason we have made this calculation. Further, we understand if at all we are going for the equity financing, then additional issue of the equity shares are required to be made. So after making calculation of the return on capital employed, we will make the calculation of the number of equity shares to be issued. And lastly, we will compute the earning per share. Dear students, over here the question specifies that you are required to advise that whether the company should expand or not. It means that we will make the computation of the current EPS and earning per share for both the plans. In case earning per share of both the plans are less than the current earning per share, we will advise that you should not expand. If at all the earning per share is increasing, then in that case the option which is having higher increase in the earning per share will be selected. That is what we understand. So friends, first of all, I am giving you explanation of the question. Earning before interest and taxes is provided as 4,50,000 right now. This amount of the earning that we have by employing the capital consisting of the equity share capital, 80,000 equity shares of rupees 10, that comes to an amount of 8 lakhs. Next is a reserves and surplus, 12 lakhs. Then we have been provided that say we pay interest of 1,20,000 on 12% debentures. So the debentures is of 10 lakhs. That is 1,20,000 divided by 12%. Okay. So you can use a calculator. It is 8 lakhs plus 12 lakhs plus 10 lakhs. So that comes to in total an amount of 30 lakhs. This is what say we understand is a kind of capital employed that we have. Use a calculator along with me. 4,50,000 divided by 30 lakhs into 100. It means that say we are earning at the rate of 15%. This is what say we understand is the return on investment. Why do we compute this? Because the question is providing the information that say whatever the additional investment of 6 lakhs that we are going to employ is also going to give the same rate of return as you are earning right now. That is the reason say we are making calculation. So in order to make the calculation of the return on investment or return on capital employed, the working notes will be like this. First working note will be calculation of the debentures 10 lakhs. Second working note will be 30 lakhs capital employed, or otherwise directly we can put the equation then. That is the way we are required to make the computation of return on investment. So I request all of you to write down answer for the question. As a student, you should not be understanding only the answer. You should also understand the sequence in which you are supposed to pursue the answer. Working note number 1, calculation of debentures. Interest is equal to debentures into rate of interest. Debentures is equal to interest divided by rate of interest. What is the amount of interest? 1,20,000 divided by 0.12. That is an amount of 10 lakhs. That is, first of all, we'll compute the debentures value. Working note number 2, calculation of return on investment. Precisely friends, we are making the calculation on pre-tax basis. It is earning before interest and taxes divided by capital employed. Capital employed is all long-term sources of finance total, which is basically used for calculation of the weighted average cost of capital. So this is 4,50,000 divided by capital employed is equity share capital plus reserves and surplus plus debentures. So it is 4,50,000. As far as the equity share capital is concerned, in that the information is given that there are 80,000 shares of rupees 10 each. That comes to 8 lakhs. Plus reserves and surplus, it is 12 lakhs. Plus debentures, it is an amount of 10 lakhs. So 4,50,000 divided by 8 plus 12, 20, 20 plus 10, 30 lakhs. Into 100 for getting answer in percentage term, that comes to 1515%. So this is the rate at which we are going to earn even on additional investment of 6 lakhs. The question says that we are having the two options of raising the funds. It is either through debt financing at 12% or by issuing equity shares at face value. So very good clarification is made that say in case we are going for the equity financing, then the price at which we are going to issue the equity shares will be face value. So working note number 3, calculation of number of equity shares to be issued. In bracket I am writing for clarification, in case of additional funds raised by equity financing. So it will be calculated as amount divided by issue price we require an amount of 6 lakhs and issue price is rupees 10. So it amounts to 60,000 shares. That is the way the number of equity shares can be calculated. Now finally 3 EPS. One is the current, second additional funds raised by way of debentures, and third additional funds raised by equity shares. So heading right down, calculation of earning per share. In that we will be having column number 1 particulars. The second column is present earning per share. Next is proposed earning per share. In that, one is the debt financing and another is equity financing. That is the way we are required to make calculation. So let us make the calculation of the earning per share, dear students. First of all, I am focusing on the present. In that, so we will start with the EBIT. It is 4,50,000. Then we will mention existing interest. It is an amount of rupees 1,20,000. There is no additional interest. It will come in the column of the debt financing. So EBIT minus interest will give EBT. 450 minus 120, 3,30,000. Income tax rate is only 40%. So the tax amount is 40% of the earning, 1,32,000. Earning after taxes, it is 1,98,000. Number of equity shares. Existing number of equity shares are provided as 80,000. So the earning per share will be found as balancing figure 2.475. No clarification is made with respect to the number of decimals. So the general instruction will be applicable to do answer up to 3 decimals. That is 1,98,000 divided by number of equity shares, that is 80,000. This is the way the EPS is calculated. Next, proposed earning per share. In case of the raising debt financing by debt financing, then what will happen? Let us see. The existing EBIT will continue to remain 4,50,000 plus additional 6 lakhs is going to generate the return of 15%. So please use your calculator. 6 lakhs into 15%, 90,000 added to 450. So overall gross operating income will be 5,40,000. Existing interest is going to remain same, that is 1,20,000. The question is clearly providing with the information that the additional debt financing will also have coincidentally same rate of interest, 12%. So additional interest will be on the 6 lakhs at the rate of 12%. That comes to an amount of 72,000. Okay. Now EBIT minus interest, 540 minus 120 minus 72. Earning before taxes is 3,48,000 into 40%, 1,39,200. 2,08,800. Dear students, the number of equity shares won't change. Why? Because we are raising the additional funding by way of debt financing. So 208,800 divided by number of equity shares 80,000. That is the way we compute the EPS. It is 2 rupees 61 paise. That is the way the EPS is calculated. Next, if you raise the additional financing by equity, again the EBIT is going to remain same, 5,40,000. Only for understanding purpose I am telling you, 30 lakhs is current capital employed plus 6 lakhs. Total it is 36 lakhs into 15%. That is also the way you can compute EBIT. Interest, only there will be existing interest, 120. So earning before taxes will be 4,20,000. Income tax rate only 40%, 1,68,000. Earning after taxes is 2,52,000. Many a times I suggest students that instead of calculating tax, you can directly take the 60% of the EBT as EAT. That will save your time to calculate the tax and writing the tax amount. 80,000 shares plus you will issue additional 60,000 shares in case of the equity financing. So total it is 1,40,000 shares. That comes to 1 rupee 80 paise. That is 2,52,000 divided by number of equity shares are 1,40,000. Okay. Now friends, what happens at say going with the first option, going with the second option. In both the cases it happens like this, that in case of the debt financing the EPS increases and in case of the equity financing it is falling down. So the company would be advised to raise the additional financing by way of debt. So write down final answer. Decision. The company should raise additional finance by way of debt. This is the way we are required to write the decision. So lastly, a summary of the entire answer. The question is providing the information about an existing company which has made investment in a business by raising the funds from equity financing. The reserves are there and also the debentures. So total 30 lakh rupees of the financing has been raised and it is invested in the business. And with that, so you are able to earn an amount of 4,50,000, means your return on investment is 15%. Now you are going to expand your business by an amount of 6 lakhs. Importantly, the question provides that say you are going to have the same rate of earning as right now, say from the expansion of the business. That is the reason say calculation of this 15% is important. Afterwards, friends, that is question is very simple. You are required to make the calculation of the EPS. The reason that say we are calculating the EPS even for the current one is that the question provides that say you are required to decide that say whether you should expand or not. And if at all you are suggesting expansion, then in that case by which source of finance. That is the reason say we make the computation of the current earning per share for calculation. Next question, question number 4. Stand Limited is considering replacement of one of its machines which has become outdated and inefficient. Its financial manager has prepared a report outlining 2 possible replacement machines, the details of which, that is each machine, is as follows. We have been provided with the information that what is the amount of the initial investment, what is the estimated useful life. For the first one it is 3 years and for the second one it is 5 years. Residual value is given, contribution per annum is given, that is difference of the sales and the variable cost, fixed maintenance cost, other fixed operating cost. The maintenance costs are payable annually in advance. So this is required to be paid in advance. All other cash flows apart from the initial investment assumed to occur at the end of the each year. So all other cash flows are assumed to occur at the end of the period apart from the initial investment, because it is at the beginning of year 1, that is in the year 0. Depreciation has been calculated by using SLM and has been included in other fixed operating cost. So over here, this is including the depreciation. The expected cost of capital for the project is 12%. First question, which machinery is more beneficial? Using annualized equivalent approach, ignore taxation. So very good clarification is made by them that say we are required to apply equalized annual criteria. Second, calculate the sensitivity of your recommendation in part 1 to the changes in the contribution generated by the machinery 1. We have been provided with the discounting factors. First year, second year, third year, that is year 1 to year 6 information is given. Then we have been provided with the annuity factor, total of 1 and 2, total of 1 to 3, total of 1 to 3, 4, total of year 1 to year 5 and total of year 1 to year 6. So this is annuity factor given and this is PVIF information is given. So we are required to say take the decision using the equalized annual criteria, that say which option is better. Dear students, over here we are required to make the calculation of NPV for both the options, and based on that say we are required to make the calculation of answer. That is equalized annual approach is required to be adopted because the time periods are different. So let us make the calculation of answer. Heading right down, calculation of EANPV, equalized annual NPV. Step number 1 is investment. For machinery 1 and machinery 2, we can see that so the amount of the investment to be made is 12 lakhs and 16 lakhs. this is 12 lakhs, this is 16 lakhs, and this investment is required to be made in the year 0. Step number 2, in that we'll compute depreciation. As far as the depreciation is concerned, basically it is a non-cash item, so it is required to be calculated only if the tax is required to be considered. Yet over here, say we are making calculation of depreciation, even though we have to ignore tax. The reason is that say depreciation is included in other expenses. That is over here. So what amount must have been included to compute the same? We are calculating depreciation. So depreciation will be calculated as cost minus scrap value divided by number of years. That is how it will be calculated for machinery 1 and machinery 2. Let us see that say how to calculate the answer. Cost is provided as 12 lakhs, residual value is 10%, 1,20,000, and the time period is 3 years. So 12 lakhs minus 1,20,000 divided by the useful life, that is 3 years. 10,80,000 upon 3, 3,60,000 rupees per year. In case of machinery 2, let us see that say what will happen. Cost is 16 lakhs, life is 5 years, and residual value is 1 lakh. So 16 lakhs minus 1 lakh divided by the useful life is importantly 5 years over there. 16 minus 1 is 15, 15 divided by 5, that comes to 3 lakh rupees per year. This is the way, say step number 2 will be depreciation. Step number 3, that is I suggest students usually to do working of terminal cash flow. As far as the terminal cash flow is concerned, we understand that is the amount that you are going to receive in form of working capital recovery, scrap value of the machinery, and if at all there is any capital gain or loss, tax effect that is required to be given. So machine 1 and machine 2, there is no working capital, no capital gain tax. So only the scrap value of the machinery is terminal cash inflow. 1,20,000 for machinery 1 and 1 lakh rupee for machinery 2. That is terminal cash flow. This amount is going to be received year 3 end, and this amount is going to be received year 5 end. That is the way the terminal cash flow can be calculated for each of the machinery. Now step number 4, that is what I usually suggest to do the recurring cash flow. As far as the recurring cash flow is concerned, in that importantly it has been given to us that maintenance costs are required to be paid annually in advance. So I'm making the recurring cash flow excluding the maintenance cost. So what will happen, dear students? It is the contribution, that is inflow. Other fixed operating cost 7,20,000. It has been like provided that it is including depreciation. So we are required to adjust the depreciation for calculation of the cash flow. That is the way recurring cash flow will be calculated, and importantly friends, I am making the calculation of answer excluding the maintenance cost. So step number 4, calculation of recurring cash flow. In bracket I am writing excluding maintenance cost. Friends, we will give its effect later on. For machinery 1 and machinery 2, for machinery 1 it is year 1 to year 3, and for machinery B it is year 1 to year 5. So we can start with the contribution. It is an amount of 11,60,000. Next is other fixed operating costs per annum. It is provided to us 7,20,000. However, it includes depreciation. Amount of depreciation is 3,60,000. So difference between both of them is again 3,60,000. Which is deducted from 11,60,000. So the cash flow will be 8 lakhs. Of course, excluding the effect of the maintenance. Friends, there is no tax, so calculation of the PBT, PAT, add back depreciation, all those things are not required. For second machinery it is 12 lakhs. The operating cost is given to us as 6,10,000 in the question, minus this is an amount of 3 lakhs. So this is 3,10,000. So 12 lakhs minus 3,10,000. So it is 8,90,000. This is the way the recurring cash flow can be calculated for each of the machinery. Next, step number 5. Calculation of net present value. Let us see how to calculate the NPV for machinery 1. It is year 0, end of year 1, end of year 2 and end of year 3. These are the three, that is, so the life of the machinery is 3 years, like that information is given. We understand that, say, we have made the computation of the recurring cash flow. It is an amount of rupees 8 lakhs. However, we know that this is wrong. Why? Because we have not taken the effect of the maintenance cost. That is the reason. So next I am writing maintenance cost. Importantly, the language of the question is very clear. Maintenance costs are payable annually in advance. Means third year maintenance cost will be paid at the beginning of the third year. Dear students, for the purpose of discounting, third year beginning is considered to be second year end. So it will be considered as 40,000 rupees cash outflow at the end of second year. Second year beginning means first year end. That is an amount of 40,000. First year beginning means year 0. That is again 40,000. That is the way the effect of the maintenance cost will be given. Then we understand that's the terminal cash flow. The amount of the terminal cash flow that we are going to receive is 1,20,000. That is at the end of the third year. That is a residual value. In the year 0, you are required to make investment. We can see that the amount of the investment is 12 lakhs. Okay. Now we understand that we can compute the net cash flow, which will be discounted for NPV calculation. In year 0, it will be 12,40,000 outflow. End of year 1, inflow of 760. End of year 2, inflow of again 760. And end of third year, inflow of 9,20,000. This is the way the net cash flow will be found, which will be discounted for the purpose of NPV calculation. So the net cash flow, year 0 it is 12,40,000 outflow. End of year 1 it is cash inflow of 7,60,000. End of year 2 it is again 7,60,000 cash inflow. End of third year cash inflow of 9,20,000. This is the way the net cash flow is calculated from end of, that is from year 0 to end of third year, which is discounted for the purpose of NPV calculation. So now we'll do the discounting at the rate of 12% present value. That is the way NPV can be found. Discounting factor for the first year is 0.893. For year 0, discounting factor is of course 1, because year 0 cash flows are not required to be discounted as such. Second year factor is 0.797 and third year it is 0.712. So present value calculation, in the year 0 it is of course 12,40,000. Then it is 7,60,000 into 0.893. It comes to 6,78,680. For the second year it is 7,60,000 into 0.797, 6,05,720. $9,20,000 into 0.712, 6,55,040. So the total of 3 is 678,680 plus 6,05,720 plus 6,55,040. It is 19,39,440 minus 12,40,000. So NPV is 6,99,440. This is the way the NPV is calculated for machinery 1. Similarly, we will do the calculation of NPV for machinery 2, and then subsequently we will compute equalized annual NPV. Yes. So heading right down machinery 2. In that again, year 0, as far as the second machinery is concerned, it has life of 5 years. It is year 0, then end of year 1 to end of year 4 and 5th year. That is the way we will be taking the cash flows. In that, first of all, I am mentioning recurring cash flow. Recurring cash flow that we have computed in step number 4. It is an amount of 8,90,000. That is cash inflow, wherein the maintenance cost effect has not been given. So it is 8,90,000. Cash inflow from end of year 1 to end of year 5. Next is the maintenance cost. Which is required to be paid at the beginning of the year. We can see that the fixed maintenance cost is given an amount of 80,000. So beginning of every year means end of the previous year. So it is an amount of 80,000. In the last year you will receive the terminal cash flow. amount of the residual value which you are going to receive at the end of the 5th year is rupees 1 lakh. Next, continuing with the table, year 0, year 1, 2, year 4 and 5th year. We will be having initial cash outflow, that is investment to be made. Amount of the investment that say we have calculated, it is an amount of 16 lakhs. That is in step number 1. So the amount of the investment to be made is an amount of 16 lakhs. So based on this, we'll compute the net cash flow. As far as year 0 is concerned, it is 16 lakhs of investment and maintenance cost of 80,000. That comes to 16 lakh 80,000. That is in the year 0. Recurring cash flow 8 lakh 90,000 minus 80,000. That comes to 8 lakh 10,000. In the last year, it will be 8 lakh 90,000 plus 1 lakh, that is 9 lakh 90,000. These cash flows will be discounted at the rate of 12%. Again, year 0 factor will be 1. Then we will compute the present value. That is for the year 0, it is again 16 lakh 80,000. That is of course not going to change. Now annuity factor is given to us from end of year 1 to end of year 4. It is provided as 3.038. That is the annuity factor. So it is 3.038. That is discounting factor from end of year 1 to end of year 5. In the 5th year, we will discount with the 5th year cash accrual, that is 5th year factor. So PVIF at 12% for the 5th year is 0.567. So we'll apply over here 0.567. That is the way we'll compute the present value. So use a calculator, 8 lakh 10,000 into 3.038. So the answer comes to 24 lakh 76,000. So 24 lakh 60,780. In the last year, 9 lakh 90,000 into 0.567. That is 561,330. Plus 2460,780. So 30 lakh 22,110 minus 16 lakh 80,000. So 13 lakh 42,110. So NPV will be calculated 1342,110. This is the way NPV is calculated. Whatever the NPV that say we have calculated for machinery 1 and 2, they are not comparable because this NPV is for different number of years. That is the reason say there is a good clarification made in the question that say we are required to make the calculation of the equalized annual value. It means that equalized annual NPV is required to be calculated for both the options. And based on that, we will recommend which machinery to be purchased. So next is calculation of equalized annual NPV. It will be calculated like this: net present value divided by PVIFA at K cost of capital for n number of years. It is required to be computed for both the machineries, machinery 1 and machinery 2. As far as the first machinery is concerned, for that NPV value is 6,99,440. That is NPV. Divided by PVIFA at the rate of 12% for 3 years. So 12% for 3 years, annuity factor is given to us as 2.402. In case of the second machinery, similar working is required to be made. This is the NPV, 13,42,110. Divided by PVIFA at the rate of 12% for 5 years. So 12% for 5 years, annuity factor is 3.605. So here is, friends, 3 years factor 2.402 and this is the 5 years factor 3.605. Based on that, so we'll compute the answer. So 13,42,110 divided by 3.605. So the answer is 3,72,291.262, and for the next one it is 6,99,440 divided by 2.402. In that case the answer is 2,91,190.674. This is the way we are required to compute the equalized annual NPV. Okay. And of course we understand the option which is having higher equalized annual NPV will be selected. So based on this working, we can say that the company would be advised to buy machinery B. The question is that, say, which machinery is more beneficial using annualized equivalent approach. So write an answer. The company is advised to purchase machinery 2. Full stop. This is the answer. Now second part of the question. The question says that, say, calculate the sensitivity of your recommendation in part 1 to the changes in the contribution generated by machinery. Machinery 1. Now friends, over here, for the purpose of conducting the sensitivity analysis, as such the question does not provide any information with respect to the percentage change in the variable. It means that we are required to make the computation of margin of safety. We are required to make the computation that by what percentage the contribution decreases. In that case, NPV will go down to 0 is required to be calculated. As far as the annual contribution is concerned, it is an amount of 11,60,000 and the time period is 3 years. So let us make the calculation of the answer like this. I request all of you to write an answer along with me. Answer for the second part of the question. In that for the purpose of conducting sensitivity analysis comma we have not been given information about adverse change in the variable. Full stop. So we will compute MOS, margin of safety, that is percentage decline in contribution comma with which NPV will fall down to 0. And friends, over here language of the question is absolutely clear. We have to do it only for machinery 1. So for that, we will work out the answer like this. Working note number 1, calculation of present value of cash inflow of contribution. That can be computed like this. It is annual contribution into PVIFA at the rate of 12% for 3 years. What is the amount of the annual contribution? It is an amount of rupees 11,60,000. So we will have working of the answer like this: 11,60,000 into PVIFA 12% for 3 years is 2.402. It comes to 27,86,320. This is what's the present value of cash inflow of contribution. Dear students, as far as the machinery 1 is concerned, it has a positive NPV of 6,99,440. 6,99,440. That is the positive NPV that we have. So we understand that, say, percentage decline in contribution, comma, at which time NPV will be 0. That is, at that time NPV will be 0. Dear students, it is very simple to calculate. It will be found as NPV divided by present value cash inflow into 100. The NPV is 6,99,440 divided by present value of the contribution. It is 2,786,320. Into 100 for getting answer in percentage term. So the answer is 25.103%. So we understand that, say, if at all our estimation with respect to the contribution is going wrong by more than 25.103%, NPV would be negative. Otherwise, this is the margin of safety that we have. That is the way we are required to conduct the sensitivity analysis. That is what we understand. So we can write the conclusion like this. In case estimation about annual contribution is wrong by more than 25.103%, comma, then NPV will be negative. Otherwise, it will remain positive. This is the way we are required to write the answer. Next question. Question number 5. Information of A Limited is given below. Earning after taxes is 5% on the sales. Income tax rate is only 50%. DOL, degree of operating leverage, is 4. 10% debenture in the capital structure is rupees 3 lakhs. Variable cost is an amount of 6 lakhs. You are required, from the given data, complete the following statement. Sales we do not know, amount of the variable cost is 6 lakhs, and so on information is given. Calculate financial leverage and combined leverage. Calculate percentage change in EPS if sales increased by 5%. That is the way the question is providing the information. So let us understand how to make the calculation of the answer for question number 5. Answer for question number 5. Let us see that, say, how to make the calculation of answer. So friends, let us see how to make the calculation of answer. Earning after taxes is given as 5% of the sales. What is sales we do not know. So let us assume that, say, the sales is an amount of rupees X. So earning after taxes will be 0.05x. Variable cost is given to us in the question. It is an amount of 6 lakhs. Difference between both of them is contribution. That is an amount of X minus 6 lakhs. From that, say, the fixed cost is deducted. What is fixed cost we do not know because its information is not given. Difference between both of them will be EBIT. Again, we do not know because the fixed cost information we do not have. Amount of the interest. You can see that, so the question is providing the company has issued debentures of an amount of 3 lakhs having rate of interest 10%. So the interest is 30,000. It is 3 lakhs into 10%. EBIT minus interest is EBT. Again, we do not know. Income tax rate is only 50%. So earning after taxes is remaining 50%. Dear students, I have already explained to you that EBT minus tax is EAT. So there is no need to calculate the tax because earning after taxes is the half of, that is in this question, half of EBT. Okay, so we can say that's over here it is 0.05x. Why? Because the profit is 5% of the sales. 0.05x. That is provided over here. So earning before taxes will be double of that. It is 0.10x. So friends, earning before interest and taxes can be calculated as 0.10x plus 30,000. So from 0.10x plus 30,000, 30,000 is deducted and we have 0.10x. Now we do not have any further information. However, we have the information of DOL, degree of operating leverage. So we can use it for the purpose of making further calculation of answer. Yes. So DOL is calculated as contribution upon EBIT. So we can say that the contribution is equal to DOL4 into EBIT. So it is 4 into earning before interest and taxes, that's we have calculated. It is 0.10x plus 30,000. That comes to 0.40x plus 1,20,000. This is the way we can make the calculation of the contribution. It is 0.40x plus 1,20,000. For the purpose of contribution, we already have this value also. So we can say that x minus 6 lakhs is equal to 0.4x plus 1,20,000. That is the way we can make the calculation of the answer. So 0.4x is transferred on this side, so it will become negative. 6 lakhs is transferred on the opposite side and it will become positive. So x is equal to 7,20,000 divided by 0.6. That is the way we can make the computation of the sales value. That comes to rupees 12 lakhs. Once we make the computation of the sales value 12 lakhs, the remaining answer will be very simple. Just I am explaining to you. Of course, we are going to have the proper working. This is 12 lakhs minus 6 lakhs. So this is 6 lakhs. DOL is 4. So contribution divided by 4, that will give EBIT. That is an amount of 1,50,000. So this is automatically 4,50,000. Amount of interest is 30,000. 1,50,000 minus 30,000, that comes to 1,20,000. And half of that is the tax that you have paid and half of that is the earning after taxes. You can see that the 12 lakh rupees is the sales into 5%. So what is earning after taxes? It is 60,000 and this is the way we are required to make the calculation of the sales. And we will be able to complete the entire table. So let us start making calculation of the answer now. So I request all of you to write down answer along with me. Assuming that sales is rupees X, comma, answer is calculated. So working note number 1, calculation of contribution. Contribution is sales minus variable cost. We have assumed that the sales is X and variable cost is 6 lakhs. That is given to us. Okay, so we got an equation. Working note number 2. calculation of earning before interest and taxes. This is going to be slightly important, friends. It is calculated as earning before taxes plus interest. This is the way it is found. EBT is found as earning after taxes divided by 1 minus tax rate plus interest. We have been given that, say, we have issued 3 lakh rupees of the debentures which carries a rate of interest of 10%. What is earning after taxes? It is 5% of the sales. As we have assumed that sales is X, so this will be 0.05x. Income tax rate is only 50%. So this is EBT plus 30,000. So the final answer is 0.10x plus 30,000. This is the way EBIT is calculated. Now using the DOL, we'll make further calculation. Now calculation of sales. For that we'll use the formula of DOL, that is contribution upon EBIT. DOL is 4. The amount of the contribution is X minus 6 lakhs. And the amount of the EBIT is 0.10x plus 30,000. This is the way we are required to do answer. 0.10x plus 30,000 is transferred on the left hand side, so it goes in the numerator. Is equal to X minus 6 lakhs. So 0.40x plus 1,20,000. X minus 6 lakhs. 6 lakhs is transferred on the opposite side, so it will become positive. Plus 1,20,000. 0.4x is transferred on the opposite side, so it will become negative. Difference between both of them is 0.6x is equal to 7,20,000. So x is equal to 7,20,000 divided by 0.6. That comes to rupees 12 lakhs. This is the way we make the computation of the sales value. And of course, we understand that, say, once you compute the sales value, remaining answer is not so difficult. I just revised this answer to you, dear students. First of all, a small working note for calculation of the contribution. It is sales minus variable cost. X is a variable assigned to the sales value. Next is the EBIT, that is EBT plus tax. EBT is found as earning after taxes divided by 1 minus T, so it is converted into pre-tax term, plus interest, that is 30,000. EBT is like 0.05x divided by 0.5, that is 0.10x. Sales value, for that the formula is DOL is contribution upon EBIT. Contribution is X minus 6 lakhs and the EBIT is 0.10x plus 30,000. Both equations we have formed above. X is calculated as balancing figure. Now we'll answer the first question, wherein we understand that, say, we are required to prepare this income statement, that is completing this statement. So income statement, in that again sales, it is an amount of rupees 12 lakhs. Less variable cost, that is 6 lakhs. contribution is 6 lakhs. Less fixed cost will give EBIT. We already have got the EBIT in an equation term. It is 0.10x plus 30,000. So it is 0.10 into x, which we have now 12 lakhs plus 30,000. So what will happen, dear students? 1,20,000 plus 30,000, that is 1,50,000. So fixed cost will be found as balancing figure. Amount of the fixed cost will be 4,50,000. Amount of interest that has already been provided to us, 10% of the debentures of 3 lakhs. Earning before taxes is 1,20,000. Income tax rate is 50%. So tax is 60,000. Earning after taxes is remaining 50%. That comes to 60,000, and it amounts to cross verification as well of our answer that 5% of 12 lakhs is 60,000, because earning after taxes is given as 5% of the sales. Yes. Now the second part of the question is extremely simple. It says that you are required to compute other two leverages. So second part of the question, in that degree of financial leverage, it is operating income EBIT upon earning before taxes. Amount of EBIT is 1,50,000 and this is 1,20,000. So the answer is 1.25. The last is, that is the next leverage is DCL. It is DOL into DFL. So it is 4 into 1.25. That is 5. This is the way it is calculated, or otherwise we can say that's the contribution upon earning before taxes. That is also the way you can make the computation of the answer. Amount of the contribution is, friends, 6 lakhs and EBT is 1,20,000. This is 6 lakhs divided by 1,20,000. Like that, so it can be computed as 5. Next question. What will be the percentage change in EPS if the sales increased by 5%? That is a question. Over here, friends, the question says that what will be the percentage change in EPS if at all the sales increases by 5%? So answer for that is very simple. Calculation of percentage change in EPS comma if sales increase by 5%. Dear students, over here the question is not providing the information about the number of shares. So a student may be confused how to calculate the current EPS, how to find the revised EPS, how based on that say we can compute the percentage change. However, friends, we understand that DCL measures what will be the percentage change in EPS for every 1% change in sales. So over here you have to apply the formula of DCL because you don't have the adequate information with which you can apply the percentage. So you can compute the current EPS revise EPS, and based on that, so you can compute the percentage change. DCL is percentage change in EPS upon percentage change in sales. Not only EPS, but it also measures what would be the percentage change in earning before taxes. It is DCL into percentage change in sales. Degree of combined average is 5. 5 into 5%. That comes to 25%. This is the way we are required to find the answer. If at all somebody is making the calculation by assuming certain number of equity shares, he or she will get the same answer. However, my suggestion is that to make the calculation without making any assumption, because we can do answer without any assumption. Let us see our next question. Next question is a theory question. Question number 6A. The question says that write short notes on bridge finance and clean PC packing credit. So let us understand that bridge finance and clean packing credit. So first of all, having a small discussion about the bridge finance before we read the related content from the institute material which you are supposed to write in examination. Dear students, writing exactly the same content is of course not required. However, your content should be related to the concept. Basically, friends, we understand that first of all, a company has an idea to do a business or to manufacture a product or to take up a project. Whatever the idea that it has, for that, it makes a detailed analysis. And this is what we understand is the point at which the investment decision chapter comes into the picture, wherein you take a decision whether to undertake a project or not. After making an analysis, you take a decision that yes, the project is worth undertaking. Simultaneously, you are required to decide about the capital structure in a way that how you are going to finance the requirement of the funds. Once you decide that how you are going to raise the funds, in that there can be debt financing, for which you may apply to a financial institution for the purpose of taking loan. After a very detailed like the project report submission, all negotiations, convincing the financial institution, you are going to raise the funds. So after a lot of the efforts, what will happen? The financial institution is going to sanction loan to you. Yes, the sanction will be made in which there will be a few conditions that they will specify. That is, subject to fulfillment of these conditions, we will disburse the loan to you. The conditions may be that you are required to submit a few certificates of government. The condition may be that you are required to invest your own funds, then we are going to give disbursement or something like that. So what happens that the company has already waited for a long period to establish or to start with the project. Now the company thinks that now it must launch the project on the as soon as possible. That is the reason. So what happens that to fill up the gap between the sanction and disbursement, what happens that you are going to take a loan, and technically this loan is given a name as bridge finance. Usually from a commercial bank, you will take the loan in order to bridge up this gap, and that is why it is called bridge finance. The rate of interest is usually high in case of the bridge finance, because the commercial bank is aware that you are in urgently need of the funds to start with the venture, to start with your project. The condition may be that now the financial institution, in a way that the commercial bank will inform the financial institution that we already have given loan to this company based on your sanction letter. So whenever you do the disbursement, you are required to do a disbursement of a certain amount to us because we already have given bridge finance to the company. This is what we understand is the concept of the bridge finance. Let us read the relevant, that is the content from the module. This is what's the ideal answer, that is, but however we understand that you may not be able to exactly replicate everything, yet you are required to give your answer which is very much near to this. Bridge finance refers to the loans taken by a company normally from commercial bank for a short period because of the pending disbursement of the loan sanctioned by financial institution. So this word is very necessary. It is the pending disbursement of the loan sanction. So the sanction has already been done. However, it has not been disbursed by the financial institution. Though it is of short-term nature, but since it is an important step in the facilitation of the long-term loan, therefore it is being discussed along with the long-term sources of the funds. Normally, it takes time for a financial institution to disperse a loan to companies. However, once the loans are approved by the term lending institution, companies, in order, this is important, not to lose further time in starting their project, arrange short-term loan from commercial bank. The bridge loan are repaid or adjusted out of the term loan as and when the dispersed by concerned institution. So as we have discussed, the term loan which is dispersed by the financial institution, from that directly the bridge loan will be paid. Bridge loans are normally secured by hypothecating movable asset, personal guarantee and demand promissory notes. Generally, the rate of interest on the bridge finance is higher as compared with other term loans. This is what we are required to write for bridge finance. The second question is, that is in A part of the question, you are required to explain regarding clean packing credit. Dear students, the term clean packing credit stands for the purpose of export of goods, you will be able to get the financing without offering anything in form of security. That is what we understand is a clean packing credit. First of all, the term packing credit means you are going to obtain the finance for the purpose of export. And the second, the term clean stands for without any security. So let us read the answer. This is an advance made available to an exporter only on the production of a firm export order. So you just have to produce that you have a firm export order, or LC, that is letter of credit, without exercising any charge or control over the raw material or finished goods. LC is basically indicating that the bank of the exporter has given an assurance to you, that is bank of the importer has given an assurance to you that if at all the importer does not pay, then we will pay to you. That is, suppose you have sold goods say to a company in United States of America, and State Bank of the New York is giving guarantee on behalf of your client that say we will make payment to you if the client does not pay. It is clean type of the export advance. Each proposal is weighted according to the particular requirement of the trade and credit worthiness of the exporter. So over here the most important thing is, friends, the credit worthiness of the exporter. The kind of net worth that you have, the kind of business that you have, the kind of past relationship that you have maintained with the bank, taking all of them into account, clean PC packing credit is given. A suitable margin has to be maintained. Also, export credit guarantee corporation cover should be obtained by the bank. Suitable margin stands for a kind of bank margin. We understand something like this. Let's say suppose I want to purchase a house property for a value of an amount of 50 lakhs. Then the bank will give me the loan of 40 lakhs or 45 lakhs, something like that. So that difference is considered to be the bank margin. Similarly, over here, margin will be kept by the bank, and the kind of insurance, in a simple language what we understand, so that is the way the insurance cover should be obtained by the bank. This is the way you are required to give answer for clean packing credit. The next theory question is distinguish, that is you are required to give the differentiation between scenario analysis and sensitivity analysis. That is a question. Dear students, the term sensitivity analysis is basically measuring that what will be the effect of an individual change on the NPV or IRR of the project. There are a number of variables say which contribute to the NPV. For example, selling price, variable cost, fixed cost, investment, life of the project, number of units that you sell, and so on. From all these factors, what is the effect of the individual factor on the NPV? That is what say is measured by the sensitivity analysis. So importantly, taking only one change at one point of time, so the sensitivity analysis is conducted. We may conduct the sensitivity analysis by taking a certain percentage change in each of the variable adversely. Yes, importantly remember that the sensitivity analysis is talking about only the adverse, that is a thing which is going to change unfavorably to the company. Selling price reduces, variable cost increases, fixed cost increases, sales units is falling down, life of the project is falling down, and so on. In comparison to that, the scenario analysis is having a kind of explanation that's taking into account the new situations, that is taking into account all the factors changing to the, that is together what will be the revised NPV, that is in the different scenarios you make the calculation. Because a kind of criticism for the sensitivity analysis is that it is not like that all variables are independent. If at all you reduce the selling price, then there are fair chances that the sales quantity will increase. If you increase the variable cost for improving the product, then in that case there are fair chances that you will be able to increase the selling price and or you will be able to have the more sales quantity. You incur more advertisement expenses, the sales quantity are likely to increase, and so on. So taking all the changes together, we are required to make the NPV calculation. That is what we understand in scenario analysis. Again, I am reading the answer from the institute publication from module. Sensitivity analysis and scenario analysis both help to understand the impact of the change of input variable on the outcome of the project. That's very true. However, there are certain basic differences between both of them. Which are the differences? Sensitivity analysis calculates the impact of the change of single, that is only one input variable on the outcome of the project, namely NPV or IRR. The sensitivity analysis thus enables to identify single critical variable that can impact the outcome in a huge way and the range of the outcomes of the project given the change in the input variable. Scenario analysis, on the other hand, is based on a scenario, or we can say different situations. The scenario may be recession or boom, that is the things may be adverse, things may be favorable, wherein depending upon the scenario, all input variables change. This is important, friends. And dear students, writing this point is very necessary, that in case of the sensitivity analysis, there is only one change at one point of time. In case of the scenario analysis, all input variable or related input variables are changing. Scenario analysis calculates the outcome of the project considering this scenario where the variables have changed together simultaneously. Similarly, the outcome of the project would also be considered for the normal and the recessionary situation. The variability of the outcome under 3 different scenarios would help the management to assess the risk of the project carries. 3 is usually optimistic, that is the best, pessimistic, that is the worst, and moderate, that is most likely outcome. Higher deviation in the outcome can be assessed as higher risk, and lower to medium deviation can be assessed accordingly. Scenario analysis is far more complex than sensitivity analysis because the scenario analysis all inputs changed simultaneously considering the situation in hand, while the sensitivity analysis only one input is changed and others are kept constant. This is what you are required to mention over here. Next theory question. Explain in brief phases of the evaluation of financial management. So answer of the question from the chapter number 1. Financial management evolved gradually over last 50 years. The evaluation of the financial management is divided into 3 phases. Financial management evolved as a separate field of the study at the beginning of the century. The 3 stages are as under traditional phase. During this phase, financial management was considered necessary only during occasional events such as takeover, mergers, expansion, liquidation, and so on. Also, when taking the financial decisions in the organization, the needs of the outsiders, investment banker, people who lend money to the business, and other such people to the business was kept in mind. That was the traditional one. The transactional, that is say the changing phase. During this phase, day-to-day problems that financial manager faced were given importance. The general problems related to the fund analysis, planning, control were given more attention during this phase. Modern phase is still going on. The scope of FM has greatly increased now. It is important to carry out the financial analysis for a company. This analysis helps in decision making. During this phase, many theories have been developed regarding efficient markets, capital budgeting, option pricing, valuation models also serves in several other important fields in the financial management. So we understand that say the traditional, it was only occasional, transactional, in that say the depth increases, and right now say it is a constant phase in which the financial management is required to be done. This is what say we are required to write. Next question. Adjustment of the risk is required in capital budgeting decision. Give reason. So why do we adjust the risk in capital budgeting decision or investment decision is required to be answered. So friends, over here we understand that say basically whenever an investor is making any investment, then in that case we can say broadly there are 2 types of investments. One is the risk-free investment and another is the investments where there is an element of risk. When I talk about the risk-free investments, something like that comes in my mind. Investment in any government security, investment in let us say State Bank of India, investment in something like that treasury bill, all those are considered to be absolutely risk-free investment opportunity. I agree that say these investment opportunities are going to give you the return whatever they have told to you. However, we understand that say practically say it does not cover even the inflation number of times. So investor is moving say from these investment opportunities to investment opportunities where there is higher return. Of course, the higher return is going to have an association of the risk. So we understand that say whenever an investor is moving from risk-free investment to any of the investment where there is an element of the risk, there is an uncertainty, then in that case definitely the investor will require the higher return. If at all I am doing business of, let us say, manufacturing and selling of a product, and I am getting the return that what State Bank of India is offering, then I end up with foolishness. I am getting the return what I can get otherwise in State Bank of India, then in that case there is no point of doing this business. When I am doing business, then in that case regarding sales I don't have certainty. Regarding the purchases, I don't have the certainty. The purchase price can increase at any time. The customer's demand can change at any time. Whatever the risk which I undertake in my business, for that I want the additional return, and that is considered to be the risk premium. So reading the relevant portion from the institute material, the use of the risk adjusted discounting rate is based on the concept that the investors demand higher return for risky projects. Higher means higher than risk-free. The required rate of return on any investment should include compensation for delaying the consumption plus compensation for inflation equal to risk-free rate of return plus compensation for any risk taken. This is something which is very important. If the risk associated with any investment project is higher than the risk involved in a similar type, that is kind of the project, the discounting rate is adjusted upward, means you are going to increase in order to compensate this additional risk borne. As we know, friends, said there are a number of industries that we have in the market, like fast moving consumer goods, pharma industry, automobile industry, banking industry, like that. So the number of industries are there. Whether all of them are having same risk? Of course no, all of them are having different risk. So accordingly the risk is required to be adjusted. You can relate over here with the point that you study in cost of capital called beta. Beta is a measurement of the risk. Beta increases, cost of capital increases. Further we understand that, say, as far as the beta is concerned, so the beta is calculated, say, taking into account the volatility of the security. A risk adjusted discounting rate is a sum of, that is total of RF and the risk premium. Risk premium means additional return that you require. The risk premium depends upon the perception of the risk by the investor of a particular investment and the risk aversion of the investor. Risk aversion means that, say, what is the attitude of the investor for the investment, whether he is an aggressive investor, whether he is a passive investor, like that. So the risk adjusted discounting rate is RF plus risk premium. RF, it is the rate of return on investment that bears no risk. For example, government security yield means it gives a return of 6% and bears no risk. In such a case, RF is 6%. Risk premium, it is a rate over and above the risk-free rate expected by the investor. Why? As a reward for bearing extra risk. For high risk project, risk premium will be high. For low risk project, the risk premium would be lower. This is what we understand. That is the way we are required to give answer over here. So friends, let us have finally summary of December 2021 CA Inter FM paper for part 8A. Okay. Question number 1A, 1B, 1C, 1D. These are practical questions. That is what we had in examination, and all of them carrying like 5 marks. So 5 marks weightage. Question number 1A, that is say from the concept of, that is from the chapter of the receivable management, and the concept was factoring services. Question number 1B from the chapter of the cost of capital. 1C, which I found to be really an excellent question, and that is from the chapter of the dividend policy. So 1B is from the cost of capital. 1C, really an excellent question from the chapter of dividend policy. 1D is from the chapter of ratio analysis. Okay, sorry, 1D is from cash management chapter. That's also very simple question that was asked. Question number 2, this is like treasury and cash management, and the concept which was tested was cash budget. In my opinion, say in the first question, the dividend policy question was really an excellent question. Second question, practical once again, 10 marks from the chapter of the ratio analysis. Again, it was a good question. Question number 3 is from the chapter of capital structure theory. Similar to this, number of questions have been provided by the institute in module. So I would say that it was quite simple question according to me. Capital structure theories. Question number 4 is from the very favorite chapter of students, that is capital budgeting. And always there is, like institute has kept this time also a question of 10 marks from this chapter. That is what they usually do. And they have even added the risk analysis in the second part of the question. So fourth is practical question of 10 marks from your favorite chapter, investment decision. A good clarification was made in the question that you had to adopt the equalized annual approach. That was a good clarity provided by them. Question number 5, that is of the leverage, missing data. So they have asked slightly a different question than what they do usually. Practical question of 10 marks, that is from the chapter leverage. Usually in leverage they do not ask this kind of question. They usually provide the data, calculation of the leverage and maximum analysis. But this was quite different. 6 question theory, and that suggested from the sources of the finance. It is from the chapter of the sources of the finance. As far as the question number 6A, 6B, 6C or 6C once again, theory questions, 4 marks from the chapter of sources of finance. Of course, we can say that the 2 marks that they would have kept for bridge finance and 2 marks for like the clean packing credit. Distinguish between the scenario and sensitivity analysis, that is 4 marks from the chapter of the risk analysis in capital budgeting. I think that a student would be able to better attend a theory question if it is from the practical chapter, because by doing the numericals your student will have more idea about that concept. The third question is from the first chapter, and the last one is again from the risk analysis and capital budgeting. The first is the basics of financial management, and the last is the risk analysis. in capital budgeting. This is the way we have the entire examination paper. So overall we can say that whatever the coverage that they had in examination, or whatever the question that they had in examination, all the questions are from the concepts which have been covered by the Navkar. Yes, Navkar book is absolutely covering all the concepts which have been tested in the mark, that is in the question, that is in the question paper. Even the theory questions which have been asked is covered in the Navkar theory material. So we can say that a student would be able to get excellent mark by doing Navkar coaching.